Hi, guys. Welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. What is cash flow? So make sure to watch the full video. Cash is the lifeblood of every business, and running out of it is the number one reason that small businesses fail. Even if you are making plenty of sales, if you don't have enough cash in the bank, your business won't be able to pay its bills and stay open. What's the difference between cash and profit? Believe it or not, it's possible for your business to be profitable but still run out of cash. That may not be intuitive at first, but it's because cash and profits are very different things. Profits can include sales that you've made but haven't been paid for yet. Cash, on the other hand, is the amount of money you actually have in your bank account. It represents the liquidity of your business, and basically, if you can't use it right now to pay your bills, it's not cash. For example, if you're making a lot of sales, but you invoice your customers and they pay you net 30, or within 30 days of receiving the invoice. You could have lots of revenue on paper but not a lot of cash in your bank account because your customers haven't paid you yet. Those sales will only show up on your income statement. How to analyze a cash flow statement? When analyzing your historical cash flow statement, you're looking at the amount of real cash you have on hand at the beginning of the month, compared to your cash at the end of the month. You can also look at your cash flow over different time frames, quarterly, for example. But a good rule of thumb is to look at your cash flow on a regular basis to better understand any changes in the health of your business. To see a visual example of how this works within a business, you can download this free cash flow example as a PDF or Excel sheet. When conducting a cash flow analysis, you'll want to be sure you understand the following key terms. Positive cash flow. Positive cash flow is defined as ending up with more liquid money on hand at the end of a given period of time compared to what was available when that period began. Let's say you started with $1,000 in cash at the beginning of the month. You paid $500 in bills and expenses, and your customers paid you $2,000 for your services. Good news, your cash flow is positive, at $2,500 for the month. If you have positive trending cash flow, it's easier to pay your bills. Positive cash flow ensures employees get checks during each payroll cycle. It also gives decision makers the funds they need to pay suppliers, creditors, and the government. Negative cash flow. Negative cash flow is when more cash is leaving the business than is coming in. When cash flow is negative, the amount of cash in your bank account is shrinking. This might not be a problem if your business has plenty of cash in the bank. But it does mean that your business will eventually run out of money if it doesn't become cash flow positive at some point. Let's say you started with $1,000 in the bank at the beginning of the month. You paid $1,500 in bills and expenses, and even though you did plenty of work and invoiced your customers for $3,000 worth of services, your customers only actually paid you $200. You're still waiting for the rest of your payments to come in. $300. Your cash flow is negative. Minus $300 for the month. If you don't have any reserves, your rent check might bounce. If you have a line of credit already established, you might rely on that to pay part of your bills. Maybe you forecasted your cash flow, and you knew that you were going to be short that month, so you made a plan to be able to cover your expenses. Cash burn rate and runway. New businesses and startups often have negative cash flow when they're first getting started. They have lots of bills to pay while they're getting up and running, and there aren't a lot of sales yet. As revenue from sales starts to come in, hopefully, cash starts to flow into the business instead of just flowing out. This is why new businesses often need investment and loans to get started. They need cash in the bank to cover all of the negative cash flow that happens during the early days of the business. When first starting out, it's important to track cash burn rate, which is essentially your negative cash flow number, the amount of money you are burning each month. You can then use that number to figure out how many months of cash you have left. This is your runway. Read our detailed explanation of cash burn rate and cash runway to learn more about how to find, measure, and adjust these metrics. Negative cash flow can also happen when a business chooses to invest in a new opportunity. The business could be betting that investing in a new opportunity now will pay off in the future. That investment could cause negative cash flow for some time, so it's important to keep a close eye on cash and have a solid cash flow forecast in place, so you know if your business is on track to stay in the black. Why cash flow forecasting is important. You'll want to monitor your historical cash flow at least once a month so you can start spotting trends with what's actually happening with your cash inflow and outflow. But it's not just measuring the past and present, forecasting your cash flow. can also help you anticipate when your business might run low on cash in the future. You can then plan ahead and open a line of credit or find other loans and investments to help you cover that point in the future when you're going to need a little extra cash. It's a lot easier to get help from a bank or investor before you're actually in a crisis where you're not sure you can cover your bills. If you wait until you're really in trouble to take action, lenders may see you as too much of a risk and turn down your request. Your cash flow forecast can also help you plan the best time to make a big purchase, like a new piece of equipment or a company vehicle. Don't forget to account for the unknown, though. Business owners can't predict the future, particularly when it comes to any unforeseen expenses they might incur. For example, a truck breaking down prematurely and needing replacement, or a data breach resulting in a forced increase in IT spend. And they also can't know for certain that their clients will pay their bills on time. So, when you're forecasting or looking at your cash flow statement for last month, remember that having some buffer is a good thing. You don't want to be in a position where you've allocated every single penny, to the point where you can't accommodate unexpected expenses. Part of reviewing your cash flow should be thinking about risk, and the effect an unexpected expense will have on your available cash. And ultimately, your ability to pay your bills. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.